Hi there, I'm James Preston, and in this segment I'll take you through the concept of depreciation. But first, please subscribe to the channel and press the bell icon to stay across the latest from Kalkine. In accounting, depreciation refers to the cost allocation of both tangible and intangible assets in the accounting statements to periods in which the assets are used. In general, depreciation also refers to reducing the monetary value of assets over time due to their usage, wear and tear, or because they have become obsolete. Depreciation gives us a fair idea of how much of an asset's value has been used up. Moreover, depreciating assets enables companies to generate revenue from an asset while expensing a share of its cost every year when the asset is in use. If these assets are not taken into consideration, they can affect a company's profits. Usually, businesses depreciate long-term assets for accounting purposes and tax benefits. For instance, companies can get tax benefits for the expense of an asset. However, the Internal Revenue Service, or the IRS, has formulated rules regarding when the companies can take a tax deduction. The carrying value of an asset is the difference between its historical cost and the accumulated depreciation. The carrying value of an asset is maintained in a company's balance sheet. Do companies have different thresholds to determine when to depreciate an asset? In accounting, depreciation usually permits a firm to write off an asset's value over the useful life of an asset. Assets, for example, machinery and equipment, are costly. Rather than recognising the total cost of the asset in a year, depreciation helps the company distribute that cost and earn revenue from it. Depreciation considers the decline in the carrying value of an asset over time. For tangible assets like inventory, equipment and machinery, carrying cost is original cost minus the accumulated depreciation. On the other hand, for intangible assets such as patents or intellectual property, carrying cost is the difference between the historical cost and the amortization expense. Thus, the formula is original cost minus amortization expense. Nevertheless, an asset's salvage value is the carrying value of an asset after all depreciation is completed. Companies can have their threshold amount determining when to start depreciating tangible assets, also known as fixed assets. For instance, a medium-sized company can set a $900 threshold, exceeding which depreciates an asset, whereas a larger company can set, for example, a $12,000 threshold, below which all purchases are expensed quickly. Why is depreciation considered a non-cash expense? Depreciation schedules are prepared by the IRS at regular intervals, enlisting details such as the number of years an asset can be depreciated depending on the class of assets. When an asset is purchased, companies can pay the entire cash outlay initially. However, the expense is spread out and is recorded gradually for financial reporting. This is because assets prove to be beneficial for a company for an extended period. For this reason, depreciation is regarded as a non-cash charge because it does not depict actual cash outflow. Depreciation helps a company in tax deduction because depreciation charge decreases a company's earnings. What is the depreciation rate? The depreciation rate is depicted as a percentage of the total amount that is depreciated every year. For instance, if a firm had $100,000 as total depreciation over the asset's useful life, the depreciation for the year was $16,000. The rate would be 16% each year. How do companies record depreciation? When a company buys an asset, it records it as a debit to increase an asset account, which later appears on the balance sheet, and a credit to reduce cash or increase accounts payable. These entries are reflected in a company's balance sheet. Again though, the entries do not affect the income statement of the company. Both revenues and expenses are mentioned on a company's income statement. After an accounting cycle, an accountant will record depreciation for all capitalised assets that are not entirely depreciated. The register entry for this depreciation comprises of a debit to depreciation expense and credit to accumulated depreciation. Thus, debit to depreciation expense flows via the income statement, whereas credit to accumulated depreciation is mentioned on the balance sheet. So to sum it up, an asset's carrying value is the difference between its initial cost and the accumulated depreciation. In contrast, the salvage value is the carrying value that remains after all depreciation is complete. It depends on a company as to what it anticipates receiving in replacement for the asset whose life has ended. Thus, an asset's estimated salvage value is an essential component for calculating depreciation. Well, I hope you found this video informative and extremely insightful, and if you did, please consider subscribing to the channel. I'll catch you soon on Kalkine.